I think we can start. I would like to welcome you all to this baby masterclass on the Sustainable Finance Certificate. My name is Marianne van der Malen. I'm head of program at the Foundation for Future Generations. And we are very, very happy to facilitate the organization of this baby masterclass today, as promoting sustainable finance is a very important concern for the Foundation for Future Generations. We think that the way we teach finance is key to this issue, and therefore we initiated a panel discussion on teaching finance during our Future Generations Summit dedicated to the transformative power of money in December 2019, also with the participation of Christel Dumas. Today, the focus will not be on training of undergraduate students, but on the training of today's leaders. And I would like to thank Christel Dumas, Marek Cudon, and Sophie Béraud for sharing with us this sneak preview into their new masterclass, and wish you a very, very inspiring workshop. And I leave the floor to you, Christel.
Oké. Ja, dus welkom iedereen. Het is een preview van een idee dat vorig jaar naar voren kwam. Het is de behoefte aan training in duurzame financiering voor beleidsmakers. En jullie zijn onze eerste studenten, of onze teststudenten. Et donc, on va vous présenter dans l'heure et demie qui suit l'idée qui a germé, pourquoi elle a germé. Et ce qu'on vous propose, c'est de tester les 3 premiers modules de ce cours. Donc d'apprendre, mais aussi c'est un test, donc ce sera de l'ordre du teaser. On ne pourra pas tout régler, tout traiter ou répondre à toutes les questions, bien sûr. And so, as announced, the presentation is in English, but after, if there are questions, don't hesitate to just speak each in your own language. As a starting point, we have this context, which is the scientific confirmation that our planet is under stress, and that this is evidenced by a new geological era provoked by mankind. This is what we call the Anthropocene. So it's evidence in the geology of the Earth that there's human impact and the ecosystems are being modified by our activity, which leads to very problematic environmental situations. But not just environmental, and I wanted to show you this graph or figure because it shows us, I think, at what point environmental challenges are interconnected to social and societal challenges as well. On this map produced by the University of Hawaii, we see the number of days during which it will be potentially impossible to live in 2100 because the temperatures will be too elevated. And we see that there are many zones where there'll be 50, 100, 150 or even more degrees, meaning impossible for humankind to live there. It sounds like an environmental story, like an environmental challenge, but if you think just one extra second about this, you realize that it's actually a social challenge, a societal challenge, because this means giant migration movements throughout the planet, and also economic challenges, of course, because these migration movements will raise many economic questions too. So this is a quick illustration of the complexity of the issues we're dealing with, and that to be able to deal with them, we need to be knowledgeable in environmental issues, social issues, societal issues, and economic issues as well. Now, if we think of the challenges that are in front of us, and I could have put the SDGs here, but I just identified some of them as identified on the Change Finance website. We have water, education, health, etc. If we think of these issues, finance is usually at the heart of them, either because finance is the solution to part of the solution to them, or because finance is part of the problem to them. And so This brings us to the conclusion that a lack of education in finance, and in particular in sustainable finance, is a problem if we want to address all of these world challenges. So what is required? Based on our discussions in these past years, we realized two things. The curriculum is problematic. We do teach a bit of, the three of us all teach sustainable finance in our courses, but it stays too anecdotal and it is too late as well. The clock is ticking. If we train our students today, by the time they become people who decide and actually influence decisions, it will be too late. So it's time to reach today's leaders and not wait for the next generation to become a leader. What we also need is this transition to a low carbon, resilient, truly sustainable economy to happen within a reasonable time frame, and a generation is not a reasonable time frame anymore. But we notice that many leaders have limited scientific knowledge on the purpose of finance and on alternative views and practices of finance. Similarly, many decision makers in the financial sectors are not socioecologically literate, we'll say, and it's hard for them then to understand the interconnections I just demonstrated between social and environmental risk associated to their investments. Which brings us to our proposal for today, a sustainable finance certificate called CFIT, which would train the leaders of today in sustainable finance. And specifically today, we're proposing to train you on these topics. The way the full product is imagined, the full course is imagined, is it's made of 6 masterclass sessions. Each session is half a day. These are spread over a semester, so spread over about 6 months. And they cover a series of topics, and each topic is led by an academic and also experts from the fields. The topics are the purpose of finance first, as we think it is very key to start wondering first, why are we doing something? What is our purpose before looking at how we're going to do it? Then a topic on systemic thinking, which is indispensable considering the dilemmas or the challenges we have to deal with. Thirdly, banking and financial inclusion. Then responsible investment. Next, responsible risk management. And finally, shaping the future towards sustainable finance. So you see that the certificate covers all missions of financial markets. They bring back purpose into each of these activities. And for each of the missions of finance, we're going to focus both on public and private financing actors, methods that are available for each of them, with a special attention to each type of actor in sustainable finance, be it institutional investors, retail investors, public investors, etc., and all of the tools that are available to them in finance, thinking about ESG investing, environmental, social, and governance investing, impact investing, microfinance, carbon finance, etc. So that is a word on why we're here and what we'd like to do with you. I'd like to move on then to the first topic, starting this class right away. And our first topic would be the purpose of finance. Marianne, I'd like to keep this under 20 minutes. So maybe you can give me a shout if I'm not respecting the timing, okay?
Perfect.
So topic 1, the purpose of finance. And to start this topic, we want to hear your opinion first. So we're going to ask you to go on an additional website, if you can open another tab in your browser, to follow this link, which we're putting for you in the chat, in the conversation of the meeting, or of the class, we'll say. So if you click on wooclap.com and enter this code, which will bring you in the right classroom, we'll say, SDG 2020, we'd like to hear your views on the following, or complete the following sentences. The financial system is, fill in the blanks. So I'll go there with you. Hopefully you have clicked by now on the discussion and found the link to WooClap. I see some of you certainly have. So here I'm sharing my browser in WooClap, which you probably see on your side as well. For those who haven't joined us yet, go on wooclap.com. There's no need to install anything, and give the code SDG 2020. Then you fill in the blanks to this question. The financial system is. And we'll give a moment for people to input their answers. We see here that it's complex. And actually the size of the words or how many times they come, right? So the key word would definitely here be complex. Prehistoric, I saw, flawed, short-term. So we have all sorts of limits or failures of the financial system. But also I see the blood of the economy, a tool for the common good, supporting towards things, the SDGs. So I see from your comments too that we have, that we identify a need for the financial system that has a role to play, right? It's not satisfying, you say it's not transitional enough, but it is desirable or necessary because it can benefit the common good, the economy, etc. I do this quiz with every finance class I have. I start every finance class by asking students what finance is. And it's very interesting to see the different groups we're facing. My ninth class students who are adults coming back to school have very negative views on the financial system. They use words you have here, that it's, no, actually I'm looking for very negative words. You say mostly unknown, that's more a fact than something negative. But you say flawed, but I hear much worse words than that from my students. And then my daytime students are usually very positive about the financial system, saying that it's powerful, that it's interesting, that it's intriguing, etc. And here I would say we have a different crowd that's very realistic about the limits of the financial system and that it's probably not adapted to today's world, but the possibilities that it also raises. So let's move on to the slides. I'm going to share my PowerPoint with you again. All right. Thank you for that feedback. And looking at the criticisms that came up in your slides, I would say the first thing we have to do, if we're going to say it's flawed, it's not satisfying, we have to redirect it. The first thing we need to do is be clear on what the missions of the financial system is. If we're going to criticize it, if we're going to improve it, we first have to agree on what its purpose is, and then make sure the purpose is, the activities are aligned with the purpose, right? And the idea here is that there are 4 essential purposes or services of finance. First of all, finance has to provide safekeeping. It keeps your assets safe, right? It's maybe so obvious we don't even think about it. Thanks to finance, your money is not under your mattress. But it's in areas where this doesn't work anymore that we realize what an important function of the financial system it is. Think of countries, for example, like Haiti, after the earthquake there. And nowadays as well, people can't rely on banks to keep their money safe, so they have to spread it, share it among their neighbors just to keep their assets safe. So that's the first role of finance, safekeeping. Then comes facilitating payments. Again, it's an obvious answer, but it's an important role. When you go food shopping, you pay thanks to your card. It provides, our financial system provides an effective payment system. And again, looking at places where this doesn't work shows us how important it is. For example, in Africa, the financial system has not been up to this mission that it has. And so phone companies have come in and provided alternatives. Payments by phone companies and all the fintechs we see now are an alternative to finance when it fails in that mission. Thirdly, risk mitigation. Thanks to the financial system, we can share risk through insurances, for example. The problem there is when the financial system focuses on the wrong risks or insignificant risks. In finance, we focus on volatility as risk, right? The movements of up and down of share price. But the real risks we have today, and you're a good crowd to know this, are actually climate risks, systemic risks that are not at all captured in our financial models. And for example, insurance companies are well placed to know this and have a real challenge nowadays trying to model the real risks, or the key risks. Fourth and last mission that we have here is intermediation. I actually saw the word come up in your suggestions on the previous slide. And yes, the financial system has a key role to play in terms of intermediation. That means matching the users and suppliers of money. If finance does that, well, the financial system is an amazing solution because some people have great ideas and need money to put them in practice. Some people have extra money but no great idea. And so making these two types of parties match can lead to great things. Now, of course, we know that it doesn't work as easily as that or as nicely as that. And there are many issues or examples where finance failed in this mission. For example, there are issues of democracy there, which is maybe why we see crowdfunding coming up, is saying, well, why would the crowd not decide what project is desirable and should be financed? And then there's the exclusion of many from this intermediation system, which leads to poverty and incapability of having jobs. And impact investing is one of the answers, or social impact investing is one of the answers to these failures. So what I want to insist on here is that there very often is a confusion between the purpose of finance and all sorts of other functions that finance does. Maybe the most cynical among you might say that the purpose of finance is making money. I argue that no, not at all. Making money is a means to reach these purposes. And others, even maybe at the European Commission, would say that what's important in finance is maybe liquidity or its stability, et cetera, et cetera. Well, these are all also means for the missions, for finance to reach its mission. So successful innovation, managing asymmetric information, price discovery, which financial markets allows us to have, right? Or even separation of ownership and management. None of these are the purpose of finance. They're all important ways to reach these purposes. So if we take a look at the current failures of the system, I've just listed 4 of them here, but you've listed them as well on, in the words you proposed. Complexity is a key issue. Excessive level of intermediation as well. The more intermediaries you have, the more fees you have, the less efficient you are, and the more distance you create between the people who own the money and the people who manage the money, and you lose purpose then. There's a lack of transparency as well. It's hard to understand what's going on in financial organizations and in different financial tools. This lack of transparency aggravates conflicts of interest. And a lack of diversity as well. There's one model, one way of thinking in finance, and we need many more alternatives, or we could even say a type of biodiversity in the financial system. So these are just some failures, to name a few, which the next modules of our course will focus on providing solutions to these different failures. I want to focus on one of the failures first, maybe, because we need to address this one and understand this one to be able to build a responsible, sustainable financial system. And that is the fact that conflicts of interest are built in the financial system. The whole idea of a financial system where other people manage your money means there are potential conflicts of interest. It doesn't mean it's a bad system. It means we need to consider these potential conflicts of interest and set things up to manage them. Financial students, financial services or institutions serve many different clients at the same time who have opposite interests. And so it's obvious that there's conflicts of interest there. And they're at 4 main levels. First of all, in the financial instruments, we said they were complex. They're highly intermediate, they lack transparency. Think about the CDOs and the housing retail scandals in the US, etc. It's because of the conflicts of interest built in these financial instruments that we had problems in the financial system. Secondly, we could look at financial markets. We have very large institutions. We could even say some of them are too big to be ethical. We have multiple conflicts, multiple conflicting roles of banks who serve as advisories and different clients on different sides of deals. So here too, the way the financial markets are built lead to conflicts of interest. Thirdly, we are mixing advisory and management services in the financial institutions. So we're dealing with very large quantities, with money-making products, with a fee system that generates more fees the more transactions you make, which is what we call churning. And then very powerful clients, which we're tempted to serve more or better than less rich clients or less powerful clients. So because of this advisory and management service, we have conflicts of interest built in the financial system. And thirdly, we have the organizational governance. The way our financial institutions are governed lead to opaque organizations because they're so large, for example. So we're going to have to manage these conflicts of interest to be able to reach a sustainable finance. What are the strategies proposed in literature and on the markets to manage the conflicts of interest? A first strategy we hear all the time is competition. Let's let fierce competition deal with financial markets, and that will be a natural way of eliminating inefficiencies. You'll see I put a question mark behind there because I think this has serious limitations, and just fierce competition won't solve all of the problems I highlighted above. Another strategy could be disclosure and communication. We need to be transparent about conflicts of interest. We need to disclose performance data. We need to disclose the rules and policies that deals with the conflicts, etc. Third strategy, having rules and policies. This is really key. Could be codes of ethics at the organization level and also rules at the European and country level. These rules are going to prohibit conduct that leads to conflicts of interest. They're going to create Chinese walls, for example. They're going to create conditions that reduce the possibility of conflicts of interest. And finally, fourth strategy, which is key, and these three need to be developed at the same time, it's structural changes. We need to separate functions, like obviously commercial investment banking should not be within a same institution because it creates conflicts of interest. We need to strengthen the independence, the integrity of functional units. We need to seek parties with independent judgment in situations in which their own judgment is going to be compromised. And for this, we need trained, educated leaders in sustainable finance who understand the challenges they're faced, the limits that exist within the system, and because they're aware of them, who can take the right decisions, which is why we need to train them, preparing them for these challenges. With our students, we do a lot of business cases because being confronted with a challenge in an artificial environment through business cases is a perfect way to prepare for the day you have a real challenge. And just like you would prepare yourself for sports by practicing before, you need to practice on business cases before being confronted to the real challenge. So in our course, we're going to develop knowledge on sustainable finance, but also systemic thinking for resolutions of problems, partly through debate and partly through content. And this is why in the minutes that we have left, I'd like to organize, we'll say debate, let's say virtual discussions maybe, on 3 questions during which you should keep in mind the following guiding principle: how could finance best serve society? Let me just check my timing. We are still good. Okay. So this is what I propose. Here's a first case. And the question I'm asking you is, would you consider an investment in this company, Colgate, a sustainable investment? I will give you a few words about Colgate so that you have information on it, and you're going to have to vote yes or no on wood clap. Ideally, if we were in a different setting, we would have a debate on arguments of why yes, why no, etc. Right? But so after my explanation of the company, you're going to vote in KULeuven, again, same website as we were on, to say whether you believe this company should be in a sustainable finance fund or not. It means in these exercises, debates, we're focusing on one activity of sustainable finance, that's the investment activity. Of course, we could have exercises on banking and insurance and pension funds, etc. Right? But we have a limited time here. This is just, would say, a teaser. A few words about Colgate then. And in the meantime, I will take you with me to the KULeuven website. So Colgate is a company working in health, among others. They sell toothpaste, they sell toothbrushes, etc., etc. They're actually excellent in terms of CSR reporting. They've been recognized year after year as leaders in CSR reporting. They're among the top 5 of their sector in terms of sustainable impact. However, they're also number 3 worldwide in terms of plastic production. And we have reports on plastic worldwide. When you collect plastics in oceans and on beaches, Colgate is among the top 3 companies that produce this plastic. So they do have a very negative environmental impact. That's about all I have to say on the company at this stage. So health products, which are good for people to use, basically. They're also considering alternatives, slowly transitioning. For example, they're the first company that proposed toothpaste with a biodegradable tube. But this is very limited for the moment. We can have your votes now. Would you consider Colgate a sustainable investment in a fund? Vote yes if you agree, no if you disagree. And for those who may be lost, as a reminder, we're on KULeuven.com. And the keyword or password to enter this session is SDG 2020. All right. You can keep on voting, but I'll comment the results at this stage already. So we have a large majority who would not consider Colgate a sustainable investment. In fact, to debrief this, we would have to look at the many different strategies that exist for sustainable investments. We'll have a class on that in the module, of course, as well. One strategy for sustainable investment that is very common is what we call best in class. So you would invest in companies that are the best performers in their sector. This is probably the 4 votes we have saying yes. It makes sense in a best-in-class strategy. Okay, you take Colgate because there are many worse companies in terms of environmental and social impact in that sector. Another strategy, or there are many different recognized strategies, but another strategy may be that you have themes that you follow in your investment. For example, you could have as a theme for investments fighting against plastic. And in that case, you would have to exclude sectors that don't allow you to fight against plastic. You could also have a more recent impact investing approach, and we'll discuss this today too, where we would look at the impact on the environment, etc., of Colgate and say, we cannot invest in that one. Let's move on to our second case.
Christel, you have 1 or 2 minutes left.
Okay, we can do just one more case then. Let me take this one. My last example, thank you, Marianne. Would you consider CRISPR, there's an R missing there, a sustainable investment? Many of you may have heard about CRISPR on the radio a couple of weeks ago. They just won a Nobel Prize, I believe it's in chemistry, for their invention. I am sharing my screen with you, and I'm not sufficiently comfortable yet to speak and share screens at the same time. So a few words on CRISPR while you think about your vote. So CRISPR is a Swiss company, research and development, that invented scissors, DNA scissors. So the DNA scissors they invented can go in the DNA and cut out the problematic part of the DNA, thereby treating many genetic diseases. This is innovative. Research and development definitely has an impact on health if you're focused on SDGs for your investments, but it does raise a lot of ethical questions too, because once the license is out there, how can you guarantee who's going to use this technology, and that we don't currently have the correct legal framework to avoid ethical issues of inappropriate use of these DNA scissors. Something else that may help you in your investment decision is knowing that the company was recognized worldwide for through the Nobel Prize. Let's take a look at your votes to finish this section or this topic. I am going to share the WooClap website to see what the outcome is. This is definitely a tricky one. All the cases I give you here are cases that I have discussed on ethical boards where we have to figure out, be it in banks or organizations or for funds, what can we put in this fund? And I see here that this is very interesting, really a 50-50 result, because indeed, there's no black or white answer. We could have a fund, again, an impact investing fund, focusing on research and development, on answering the challenges, including health for all challenges. And then you would say, yes, we need this investment in our fund. You could also have discussions in terms of what are the unintended consequences of this. Are we ready nowadays? It's not a US company, it's a European one, but what does the European legislation allow or foresee for this? And based on that, you may want a no. The lesson for this, or this case, and we keep on having 50-50, I would say the lesson of this case is to do finance in a sustainable and responsible way. You need, on the one hand, mathematical models, spreadsheets, numbers, data that allow you to take the right decisions, but that is not enough. You also need discussions. You need sharing point of views. You need debates. You need ethical boards in which you would debate this type of investment and situation to try to reach the most appropriate decision. And with this, you had a first view or a first taste of what the first topic of our course would be. And I suggest we move on to the next topic with Marek.
Good morning. Thank you, Christel, for this introduction about this idea of the baby masterclass, the Sustainable Finance Certificate. I'm very pleased to be with you today, and indeed to give you like a flavor of what could be a session about financial inclusion. So, similarly to Christel, I will share my screen with you. I hope you can see it. Yeah. If someone can just confirm that it's okay like this. Thank you. Voilà. So just to start and financial inclusion, just a picture. This is a picture of the place where a couple, a household in fact, lives. It's in Bangladesh. And the name of the couple, or the two parents, is Hamid and Khadija. So that's a place where they live in the slums of Dhaka in Bangladesh. So that's a picture from 10 years ago. You will see why in a few minutes why I start with this picture, because I guess it will be an interesting starting point, but also an interesting point to reflect about what we have to say about financial inclusion and sustainable finance. So why do we talk about financial inclusion? Let's start about just a few figures, a few graphs also, basically showing you that even today we have around 2 billion people, according to these recent figures of the Global Findex data. We have today around 2 billion or 1.7 billion people who lack access to financial services. So this is the picture. You see the different circles. The size of the circle is related to the absolute value. So it's not relative, it's absolute. But still, you see that in many countries, you have people who do not have an account and who do not have access to financial services, at least in traditional bank or in traditional financial institutions. So today, in 2020, it's still a real challenge. It's still a prevalent issue. And we still have a lot of things to do to address this issue indeed. So having that in mind, in fact, what has happened is that you have a few financial institutions now, different type of institutions that have started to address this issue, at least whose mission is to address this issue. Just to give you one example on your left-hand side of this organization, our mission is to ensure that every individual and every enterprise has complete access to financial services. So you see that many initiatives, and we can relate them to social innovation in many cases also, have started operations specifically dedicated to this topic of financial inclusion. They were organizations, bunch of people, entrepreneurs, social entrepreneurs sometimes, who really wanted to address this issue and to set up an institution. One poster child of this is obviously microfinance institution that was started in the 70s to address this issue of financial inclusion. And they have mushroomed, definitely. So we talk about more than 10,000 institutions today. And that's probably the early days of this issue, at least of the recent issue also. Long time ago, even before, you had cooperatives, credit cooperatives that have existed for a long time. And this credit cooperative also, in one way or the other, help to increase, let's say, the outreach to make sure that financial exclusion is less prevalent, at least. Since we are in the SDG forum, just let me relate it to two of the SDGs. Probably we could think about other ones, but definitely it's related to the SDG number 1, the issue of poverty, and we'll talk about that in a few minutes, why it could be related to poverty and why financial inclusion could be a tool to fight poverty, but also the issue of decent work. Here we talk about micro-entrepreneurs in the sense that these people may need access to finance to develop some activities, but all in all citizens may need access to these services, and also issues related to the economic growth, or let's say economic performance, or the economic setting. So while it may look obvious to many of you to relate financial inclusion and sustainable development, in fact, historically, it's not so obvious, in the sense that many initiatives, at least historically, related to social economy, to financial inclusion, were rooted in social economy. If we take the example of Christel in Belgium, which is a cooperative and one of the flagship of the social economy sector in Belgium. This institution has existed for a long time, and it's definitely rooted in the social economy sector in Belgium. Okay, and in fact, we have reflected on this issue with a colleague from the University of Liège, Benjamin Heubrechts, and we have used this image, the distant neighbors versus bedmates, in the sense that historically, while they were links, but at least in terms of communities, these two communities were not so tight, indeed. The sustainable development community historically was originally emphasizing on the environmental dimension of sustainable development. And definitely they were kind of separate communities. So as you can see in the cartoon, they were close neighbors. It looks obvious that there are some common issues. They were looking at each other, but it was not like they were working or they were. Today, it's probably a bit different. We have, thanks to the SDGs also, this type of community, this vision of a just transition, relating these two elements. And for instance, people who work on financial inclusion also work at least more and more on environmental issues. So here you have the example of green finance, people financing, solar panels in poor countries, in the south, in developing countries also. So you see that there are more and more links. Okay. So that's the first part. So that's the what. So we talk about financial inclusion, including the people into the financial sector, fighting against financial exclusion, So that's what we have seen. Second question is the why, isn't it? After the what, the why, what could be the reason, the motivations? What could be the different elements explaining, this willingness of many people to work on financial inclusion? Historically, one of the reasons, and here you have a graph of the World Bank published 10 years ago, but one of the reasons why people were interested in financial inclusion is because they saw this type of correlation. You have here the gross national income, the GNI per capita, here the domestic credits to the private. That there is like a correlation between these two. And indeed, a lot of people have explained or have assumed also that this correlation could be related to kind of causalities, that by including people into the financial sector, by strengthening basically this financial sector, and in this case, the proxy which was used is this domestic credit to the private sector, you would also get into, or you'd allow society, the economic actors also to develop, and therefore the GNI per capita would also increase, okay? So the one reason, and at the macroeconomic level, is this kind of correlation. And indeed, if we take Belgium here, we have a high GNI per capita and a high level of financial inclusion also. Okay? So that's a second reason also. If we look at the macro level, if we get back to the enterprises, to the actors, the banks interested in that, the actors from the social economy, like the cooperative interested in that. There are many reasons why they've been active in this sector, or they've started to develop their operation. As we have seen with this image of the slums in Dhaka, one of the reasons is poverty alleviation. Let's face it, in many countries, the people who are financially excluded are also socially excluded, politically excluded. So there are a lot of reasons to think that by helping these people, by allowing them to have access to various financial services, such as access to credit, savings, insurance, and remittances, for instance, it will help them to have a better life. Okay, so that's the first reason, and that's an intrinsic motivation. Intrinsically they were passionate about this cause, and they really wanted to change the world working on this issue. Okay, so that's one, and probably the first and the main reason we would think about. The second reason could be an issue of innovation. There is this image in the courses of innovation marketing, indeed, that you have to think out of the box. It's not a box here, it's a ball, but at the same idea, They were pioneers, and we can take the example of India, for instance, where you have ICICI Bank, the second largest bank, commercial bank also, that started, which started to have some specific products designed to include the poor. So it's not just a question of downsizing, of having a smaller loan size, of having a lower savings balance. No, it's really a question of designing products specifically for this. So why do they do that? They do that because sometimes it's kind of a saturated market, to reuse the image of the bull. There are so many fishes that they really would like to have more hair, and therefore they think about new targets, about basically innovating and finding new targets. Obviously, they could do that because of intrinsic motivation. Also, obviously, there are some pioneers, some leaders of these banks that wanted basically to also play a social role. But it could be also strategically because there's a saturated market, or also because of regulation. Once again, to reuse the example of India, in the case of India, the Reserve Bank of India decided to force institutions to be more active, to open branches in places where you don't have any financial institution. So in some cases, regulatory frameworks have pushed financial institutions also to be more inclusive. So there are many different reasons why we have more actors, let's say, active in the sector of financial inclusion. Okay. Why do we still care about that? First, we have seen that it's not an issue which has been solved. I mean, we have hoped for a long time that it will be solved, but it's less. It's not solved at all, as we have seen. 1.7 billion people lacking access to that. There is a gender dimension, as you can see here. The gender gap is still huge. So the difference between the men and women still exists, and certainly in developing economies. And while we spend a lot of time to talk about credit, in fact, there are a lot of needs in terms of savings, and probably for the poorest people also, having access to very good micro savings, to good savings products, could be as important, if not even more important, according to some recent impact surveys. And as you can see in this graph on the right-hand side, basically you see that in the South, in developing economies, there is a minority of people that save formally, so meaning informal financial institutions. Many of them save using other methods of semi-formally, so a semi-formal institution in terms of the regulatory framework. So you see that there's a huge need. And when you are poor, one of the key issues is obviously uncertainty. The fact that you may have really unstable cash flows, that you may have cash flows during a few weeks, a few months, but then during a certain period, you don't have any cash flows also. And savings can help to deal with that. So how? As I said, historically, the how was related to traditional credit officers. I know you on the left-hand side, you see this picture of one of these actors. I talked about Christel, but obviously there are other historical actors. Think about Hefboom, also in the north of the countries also. And typically, what's the intuition that we have is that there is a project V here. Like you have any type of project, you come to your credit officer, and this credit officer analyzes it, and then give you a credit to finance projects. And that's the image that you have also on the right-hand side. These group loans, well known in India, in Bangladesh, for instance, and in many other countries in the world, where you have access, or that facilitate, let's say, access to credits also. But today, in 2020, the how is probably very different. Mobile banking is booming, in many countries. And why? Because 2/3 of the unbanked adults have a mobile phone. So you see on the right-hand side, these images. People who are unbanked, in fact, have access to mobile banking, to mobile services, and therefore they could be very good clients in terms of mobile services. And that could help them a lot, isn't it? And that thanks to the cell phone, they could have access to these financial services, but also access to information. And this information could be very valuable also for them. And as I said, it is increasing. If you look at the left-hand side, you see the figures, the statistics in Africa, with the spread of mobile banking in Africa. And you see that certainly in the sub-Saharan Africa, the figures have increased dramatically. We can think about Kenya as a key example, obviously, but think about Tanzania. There are a lot of countries where it's increasing. There's still a lot to do, but there is a new wave, and certainly financial inclusion will be more and more related to that also. Talking about mobile banking, it's one thing, but also financial inclusion, as you see here, it's also trying to give access to the poor to traditional services such as an ATM, okay? And that's what many formal finance institutions try to do. So mobile banking can help. Obviously, the marginal cost could be very limited with mobile banking, but other financial institutions really do their best to provide also access to other and more traditional financial services. So today, the how of financial services is also that, something that probably 20 years ago could have been seen as something which would be difficult to imagine. But today, this has changed also, and certainly in many African countries, it changed. Okay, so for the last 5 minutes, let's get to the lessons we can draw of all this phenomenon. It's just a baby masterclass here. Obviously, we would spend much more time. In a normal setting, we would have probably a case study, a teaching case study that we will read, that you will read before. We would discuss this case study, give you an example, and then trying indeed to, in an interactive way, having a few questions and a few debates related to this. The motivation, all this would have probably come from the debates with the class. Here, in terms of lessons, the first lesson we could draw is probably the fact that access is not everything, isn't it? Here you have a door, So it's not because you have access to something that you try to address all the locks, isn't it? That you solve all the issues. It's one thing to have access, but then there is an issue of use. Access doesn't mean that you use the services, and it's not because you use these financial services that you always get out of poverty. Okay, and that allows me to get back to this first picture. You know, the couple Hamid and Khadija, people, this household living in Dhaka. What you see here gets a bit more technical. It's not too technical, but a bit more. What you see here is the balance sheet, in fact, of this couple. So you have all the assets, the liabilities here. And what is striking, probably in a normal setting, we would spend 20, 25 minutes to discuss that also. But what is striking to already give the answer is the fact that here, you see a huge diversity, a diversity of assets, but also of liabilities. So that means that this couple, who is extremely poor, they live with $1 a day. So just $1 a day, even if they are very poor, they have very different financial assets and very different financial liabilities. When we talk about liabilities, we talk about sources of financing. And what we see here is that even very poor people, in this case, they have access to microfinance loan, but also to a private interest-free loan, to wage advance, to the savings health for others, to shopkeeper credits, to rent arrears, and so on. And this comes from a book of 4 American colleagues, one from South Africa. Basically what they find in their survey, so they have surveyed people like a bunch of households in South Africa, in India also, in Bangladesh, and what they found out is that all of these people have at least 5 sources of financing. So at least 5. So that's huge also. So it's not just having a door, it's also being able to manage, you know, all these sources of financing here. Here they don't have access to traditional banks, but they have access to other services also. Okay. So before I get to my conclusion, let's try to link, you know, this concern of financial inclusion with the current COVID crisis. Indeed, what's going on in this crisis is that we know, obviously, we move towards a society which is, I mean, if not cashless, but which today uses more and more digital transaction in all the countries, in Europe, in Belgium, but also in other countries in the South. And this digitalization process could probably speed up also what we talk about in terms of mobile banking. There is a lot of interest today of many actors, cell phone providers, for instance, that join force with financial actors, with banks, and so on. And because of this crisis, probably that this trend will be reinforced. The second element is the fact that there may be a responsibility of the financial industry. We know that there are going to be a lot of economic consequences in many countries, including in Belgium. That this sanitary crisis will be related to probably what we could call an economic crisis. You know, people who will be made redundant. It will be very difficult for micro entrepreneurs also to have access to credit. And therefore, there is real issue and a challenge to make sure that everyone is included, that there is no one left behind. And probably in these circumstances, what history tells us is that when you have economic crashes, so economic crisis, there is a real need to refinance. There is a need to help micro entrepreneurs or any type of activities, any type of financial services. Okay. So to conclude, a few takeaways of these 20 minutes. First, while financial inclusion may have seemed relatively easy and straightforward in the beginning, what we can see is that it's a complex issue. I mean, we have seen with the example of Ahmed and Khadija, it's a complex issue because it's not just a question of having a door, it's a question of money juggling also, you know, juggling with different sources of financing. It's a multidimensional issue, as we have seen. It's not only a question of finance, economic, but it's also related to social issues. So it's not just because you have access to credit that you will be you get out of poverty. No, there are a lot of issues, sociological issues, sometimes political issues that are related to that. So we need to take that or to embrace this topic from a multidimensional and probably a little bit multidisciplinary perspective also. So the key challenge today when you talk about financial access is to go beyond downscaling. So not just decreasing, the average loan size, but really to be client-based, needs-based, as we can say. So to adapt to the needs of the client. And that's a real issue because it's not, when you have really a low and then frequent revenues, what you need is not just little amounts, but also amounts that may vary, that may be even more flexible. And the challenge is that the more flexible you are, the more costly it could be, to offer these services also. So that's a complex issue also. And as we have seen, there is finally an integration of the topic or the world of financial inclusion with sustainable development. So probably today, if we have to think about financial inclusion and let's say financial sustainability, we need this 360 perspective. Obviously, it's like a clin d'œil to the Fondation Génération Future, but definitely when we think about this issue today, if we want to integrate all these issues and to think as the SDGs in various ways, we need to integrate this 360 perspective and also for financial inclusion. In case you are more interested, just 2 words of advertisement, or if you want to go further, we just published a few weeks or months ago a book related to this topic of inclusion in microfinance with the 2 close colleagues who are co-directors of the research center of microfinance, Marc Laby from Mons and Ariane Zafas. And in this book, you will find, in fact, many elements that I just addressed, but in 200 pages. And then there are chapters basically related to these different topics. So in terms of readings, that could be at least a good entry point. Voila, that's what I had to say. At this stage, I guess I will give the floor to the third part with Sophie.
Thank you, Marek. I will try to share my screen. Okay. So I hope you can all see the slides. I can't see you anymore, so if you can just let me know if... Okay, thank you, Marek. Okay, thank you. Yes, so first, I would like to apologize for not having prepared a more interactive session and more prepared session as my colleagues have done just before me. My main excuse is that I'm currently on maternity leave and that I have had very little time to focus on academic duties so far. So we are celebrating today our daughter's first month of life, and so this have been quite hectic times so far. But I'm a bit lost in translation right now, but I'm still very happy and glad to be among you all in our virtual assembly today to talk about this great project of a short course that we've called Baby Masterclass that we have designed with my colleagues and friends Christel and Marek. So my name is Sophie Béraud, and I'm a professor of quantitative methods and finance at the Université de Namur. And so now we have talked about the motivations for such a short course, the purpose of finance with Christel in general, financial inclusion with Marek just now, and because I'm interested in numbers, and because also we are participating to an event that is dedicated to the SDGs, so the Sustainable Development Goals, which are a bunch of indicators. I think there is one crucial issue that we have not tackled so far this morning, and that I am going to talk about a little bit now, which is how to measure sustainability, well, and the need for systemic thinking to do so, and design appropriate economic policies. So this is the general agenda for this part of the course. Again, the presentation is not specifically designed for today's talk, so there are too many slides. Don't worry, I will not present the 60 slides here, but I will try to give you a flavor of what could be a session devoted to systemic thinking and metrics and measures. So I would like first to start with a quote that I like very much, and that I borrow from a book from Éloi Laurent that he wrote in 2018, devoted to measuring tomorrow. And he's already quoting someone here, who is William Bruce Cameron, and not Einstein, because this quote is generally misattributed to Einstein. That is, not everything that can be counted counts, and not everything that counts can be counted. And in our context, this is very true. So if we take the example, an easy example of the GDP, of the gross domestic product, we know very well now how to measure GDP. We know how to measure it, how to model it, and even how to predict, to forecast it over the short, medium, and long run. But GDP is probably not the most accurate, the best measure that we can think of what counts most, right? And I will go back to this later on. However, when we want to measure really what counts most, for instance, the well-being of a society, or the sustainability of our business activities, this is much trickier. Okay, and this is so there are things that we know how to count, but those are not necessarily the things that counts most. That's the message. But obviously there have been attempts to measure things that counts, and especially the SDGs. So the Sustainable Development Goals are an attempt to, among all the various initiatives, to cope with what counts. And okay, so I will go directly to this shortcut. I had prepared too many slides, so let's go here. And to have a look on the SDGs that you know probably by heart already, so I will not detail all the SDGs. So the SDGs are an attempt to measure what counts, okay? But there are, however, some limitations regarding these metrics and these objectives, about not the objectives per se, but at least regarding the metrics that serve to monitor and measure how well we do in terms of these objectives. The limitations that I can think of are the fact that there are many different indicators, so numerous isolated indicators that are not all compatible and consistent between each other, and which calls for a more global approach, a more, let's say, holistic or systemic approach. Now, if we focus on one objective in particular, and that will go back, we will then go back to the GDP then. Objective 8, which aims to promote sustained, inclusive, and sustainable economic growth, full and productive employment, and decent work for all. If we look at the indicators that aim to monitor this objective, the first indicators are these ones. So if you look, the first target is to sustain per capita economic growth in accordance with national circumstances, and in particular, at least 7% gross domestic product growth per annum in the least developed countries. Okay, so basically the indicator that is relevant to track this objective is the annual growth rate of GDP per capita, or the annual growth rate of GDP per employed person, okay? The problem with GDP, or you may be already aware of that, is that it's not, it doesn't necessarily measures well sustainable development or even economic well-being of the country, since activities, for instance, such that are detrimental to the long-term economy, like, for instance, deforestation, strip mining, overfishing, even murders or terrorism, increase today's GDP. Okay, and besides, GDP uses market prices to value goods and services, but it excludes the value of almost all activity that takes place outside markets. And for instance, GDP omits the value of goods and services produced at home, or for instance, if we take a very concrete example, care activities. And I'm sure that all of you now given the current context that we live, of the importance of care in our society. Those are our pitfalls of the GDP measures as a good measure to assess the sustainable development. And finally, there is a clear positive link between GDP and energy consumption, or especially oil consumption, and then CO2 emissions. So here, this is a graph that I borrow from the website of Jean-Marc Jancovici, who is a very well-known specialist on those issues, and which relates the GDP expressed in billions of constant 2014 dollars and energy consumption expressed in millions of tons of oil equivalent. And what we see is that the more to feed GDP growth, we need more to consume more energy, and especially to consume more oil, okay, which is incompatible with reducing CO2 emissions. Here, if we focus especially on oil consumption, we see that the links, the linkages between the two is a bit more complex. And if we divide 2 periods of time, we see that there is a start of a decoupling between GDP growth and oil consumption. But however, it is still a positive link, which means that to have more GDP growth, we need to consume more energy, that is more oil in particular, and then emits more CO2. So that's that again is a drawback of GDP, because if we want to use GDP as a measure of sustainable development, we cannot have a measure that goes hand in hand with increasing CO2 emissions, right? So the limitations here show that we need a more global approach of the question of sustainable development. We cannot focus on isolated metrics, and especially, I give you just one example here, and very specific, very peculiar, of the GDP. But what we need is a global systemic approach of the problem. Before detailing a bit what is a systemic approach and what is a systems thinking, I want just to show you some answers that have been proposed to tackle those issues already in the literature. So one overall critique that has been made to the SDGs is that the SDGs were great objectives in a general context, but they were completely disconnected from the limitations of the planet. That is the planet boundaries. The planet boundaries is a concept that has been developed by a scientific group of researchers in the early 2000s in several papers. One, the seminal papers being published in Nature and Science, dealing with the representation of the physical limitations of our planets. So this is what is represented here, and this graph features the updated version of their graphical representation from their paper. And what we see is that we have already reached 3 of the various boundaries that are expressed here. Meaning that if we are in the green zone, everything is going okay. If we are in the yellow zone, this is a zone of uncertainty and increasing risk. And if we are in the orange zone, we have reached a high risk zone. And when it's completely complete, it means that we have already reached the planet boundary related to these objectives. And this concerns biosphere integrity here, or biochemical flows here, for instance. And one development that has been proposed by this team of researchers that are gathered in the Stockholm Resilience Center is to re-explore the SDGs in a way that is compatible with the planet boundaries. Okay, so that there is a new approach which is embedded in what they call the Earth 3 model, which is an attempt to make sure that all the SDGs, all the objectives of the SDGs can be compatible with planet boundaries for a 2050 time horizon. Okay, so this is a modeling that explore different pathways to make sure that these objectives are met with the compliance of the planet boundaries limitations. Okay, and overall, there are 4 possible pathways depending on how fast and how hard we implement changes right now to make sure that these objectives, again, do not go over the planet limitations by 2050. Okay, so this is just to give you an idea of where we stand now regarding the SDGs and potentially systemic approach of the SDGs. Now, if we want to go into more details and try to understand what a systemic approach is in a nutshell. So the traditional thinking generally thinks in reductionistic terms, in the sense that if we, for instance, if we monitor individual metrics such as GDP, and that we make sure that GDP complies with the targets that we have fixed, then we're good and we will reach the objective that we have assessed. The problem is that most of the time, targets, objectives are not isolated. They have to be understood within an ecosystem of relations and dependence paths. And this is where systems thinking comes into play. So system thinking draws from diverse disciplines such as mathematics, biology, engineering, computer science, management, philosophy, communication, psychology, or even sociology, to provide a holistic method for dealing with problems in any discipline. And it is scientifically grounded in systems theory and in network theory, as I will show you a little bit later, and a wide variety of transdisciplinary supporting principles, providing a discipline agnostic approach to address these problems. So, for instance, and those slides I have taken these slides from a course that I give in network and systems systemic approach to economic and financial problems. Explains why we need to go from reductionist approach. So, for instance, to say, okay, we can analyze a system by simply analyzing the components of the system. For instance, we can analyze the financial system by considering the individual financial institutions composing the system. So if we focus on banks, for instance, or other financial institutions, and we monitor the individual activities of those banks, this is sufficient to make sure, if everybody behaves well, to make sure that we control what we want to control. So, for instance, if we want to make sure that to make sure that there is no further financial crisis, for instance, we have to monitor banks' individual activities. So the level of their debts, for instance, the level of their individual ratios, traditional financial ratios. And if we're good, then the system will be okay. The problem is that it doesn't work like that. Banks are interconnected. They are indebted to each other. They have relationships. It can be, again, cross-sectional debt relationships. It can be the fact that banks have similar investment portfolios, and when there is a shock affecting one portfolio values, then other banks are also affected because their portfolios is similar to those of the other banks. And so there are relationships between banks, and when a shock affects one bank, then it will diffuses throughout the system and affect other banks. So this is something that has been at core of the analysis of the recent financial crisis, and moved from an individual risk analysis to a global risk analysis and a network risk analysis to measure systemic risk and how risks diffuse within a financial system. But generally,
just to say that you have more or less 3 or 4 minutes left.
Okay, so I will be fast then on the rest. Okay, thank you. So this systemic thinking is really important. So I had details on what kind of how well it can describe different kinds of system, be it a natural system, insect colonies, for instance, the brain, or the immune system, or the human genome, and also obviously, well, social networks, but also financial networks, like here. But okay, if we want to use this the illustration that I've just given to you about the systemic approach of financial risk. So the case of the recent financial crisis and the development of network tools to assess institutions' risk and transmission mechanisms. There has been new metrics of financial systemic risk, new ways of thinking the financial system, from too big to fail to too interconnected to fail, and the articulation of various sources of risk to better align the dynamics at stake. This should also serve as an inspiration to provide a new way of assessing environmental and social risk within the financial system. And here I give you just one example of how well we could do by having a holistic approach. And I go back again to the GDP and to growth measurement. So here I just present a very schematic presentation of the general monetary and multi-sectoral macrodynamics for the ecological shift, well, the GMES model, which is a tool to try to model an economic system by taking into account climate economy interactions. That is the fact that when you produce, well, you produce goods and services, but also CO2 emissions. And then you accumulate CO2, and you have radiative forcing and temperature changes that have an impact on real output. There is this circularity and the feedback loop that has to be taken into account when making economic decisions. And this is the way of thinking that we should emphasize, not only to analyze growth, but also to analyze risk metrics that will serve to provide new ways of doing risk management. Okay, I think I will stop here, and if there are any questions, that will be the occasion maybe to have some interactions after all.
Exactly, because that's just what we had planned now. We thank you for your patience, your attention, for being such good students. But of course, that's because questions were not possible orally. So what we suggest now is to have 10 minutes of Q&A using the chat. So you just post your questions there. We'll read them and address anything as a group. So let's see if we have questions in the chat. We have a first question here. Blockchain technology brings accessibility, microfinance, transparency, traceability, security, and decentralization. Its first application to Bitcoin has shown that a community can, by gathering and believing, create a currency that has value. There's a huge international community that supports the achievement of the SDGs. Do you believe that we can use this force and this technology to create a targeted money to finance the 17 SDGs? And an additional question here is about donut theory. So what are our views on blockchain technology and the SDGs, and on donut theory and the SDGs, right?
Big question.
Yeah, it's interesting because it's really linked to what you just presented, saying we have these different models that coexist, and the whole idea now is to make them fit together and think together. I know that on donut theory, there's a whole project going on in my school for the moment, maybe elsewhere too, to advise the Brussels region on how to adapt its economy to the donuts. And of course, they also think in terms of SDGs. So de facto, everything will have to fit together. I know we don't have that model yet because we're working on it, fitting donuts and SDGs. I don't know if anybody else is working on making the others fit together.
Yeah, I know that the donut economy is very much related to what I have presented regarding the planet boundaries. So in the donut economy's representation is directly linked to those planet boundaries, and it's the similar schematic representation than the framework of the planet boundaries apply to economic and financial systems. So I think this is very much compatible with what I've just presented. The need to make sure that the SDGs are comply with the planet boundaries and are reachable without exhausting the planet. So this is something that I'm very positive about. Now turning to blockchain technology, I'm not an expert on the topic. This is a wonderful tool, but that comes with great powers comes great responsibilities, as Spider-Man quotes, and I think this is very true with blockchain technology. I'm not exactly sure about how it could fasten all and the realization of all the SDGs. I'm sure this can be a tool among other tools, but I'm not sure that it will solve all the issues. And especially, regarding the transparency, I'm not completely sure about this aspect, this dimension with regard to blockchain technology. I'm a bit skeptical about that, but again, I'm not an expert, so maybe I will leave the floor to someone who knows better than.
But maybe we can add to that the idea of this course is that we will have experts coming in and completing what we say on different topics, and that people in the room will have a lot of expertise too, which brings us to the next question, which is, what about all the
just one word on this issue, maybe to relate this too. First, on the question of the blockchain, there are some cryptocurrencies. So we published 1 year ago a paper in Journal of Business Ethics where we talked about currencies, including cryptocurrency and the common goods. And in fact, we documented the fact that there are some cryptocurrencies using blockchain technology for the common goods, so for social or environmental objectives. So obviously, it's a minority of them, so it's possible in terms of democratic governance and so on. It makes sense, but there's a long way to go in terms of for the environmental performance of the blockchain technology, which could be problematic and so on. And just rapidly on the donut theory, what's interesting, I think, in the donut theory is that the beauty of the SDGs is that it includes the social, the environmental dimension, the economic dimension. The risk is sometimes, I guess, the tension is that there is a tendency to have some cherry picking. So you may I had a conversation with an incubator recently who told me, 90% of our projects are related to the SDGs, and in fact, it's just pointing one SDG without having the coherence always of the mindset. What's probably interesting in the donut theory is that there is a coherence, isn't it? Like Sophie said, you have the planetary boundaries, you have the social elements in the middle of the donut. So it allows to have this coherent thinking, which I think is interesting for that.
So Marek and Sophie, we have here good advice to us regarding all the good examples of sustainable finance, like the Global Alliance for Banking on Values, etc. And Adrian's asking us if we're going to review those and take the lessons learned from those during the master class.
Yeah, that's an excellent suggestion.
Obviously, yes. So we're going to look at stakeholders. We said the retail parties, the institutionals, the public parties, etc. Using examples. The three of us have the advantage that in addition to our teaching, we do service to society, which includes a lot of advice or collaborations with different actors. And so via these networks, we already have many links with these good examples and good actors. We're hoping that in the classroom, there'll be many examples too. And I'm guessing here in the room, there are also examples. So if you feel that you have something you need, you want to make sure we should share, definitely feel free to contact us. I don't know if you want to add something, then I'll read the next question. The SDGs could also change on intellectual property. This leads to competition instead of cooperation. Copyrights could be changed to a kind of bonus system for inventors. Any ideas on this?
Well, again, I guess I'm not at all an expert on these issues. To be sure to understand the question, so your suggestion is to try to provide some ideas to make sure that we move to more cooperation instead of competition system, if I understand well. Well, I totally agree with that. But well, how to implement these changes, then this is beyond my knowledge. But I know that besides copyright, I mean, there is a entire set of propositions regarding copyleft and open source accessibility and all. I mean, indeed, this is something that could be discussed, but this is far beyond my my knowledge and my competences. So I don't have any specific answer to provide. I don't know if my colleagues.
Yeah, but definitely we're hoping that in class we could have very interesting debates on this type of question. If I understand well, you're suggesting the answer could be through different financing solutions, different remuneration forms, etc. And so exploring these alternatives, and we certainly won't have the answer to all, but we're very happy to open debates and open new possibilities or new alternative futures through these debates. So
just rapidly on this issue, Just Stiglitz has worked on this issue of intellectual property and made the suggestion of people property rights. So we could relate it also to this issue of indeed what is private, what is the common goods, what is public goods, and so on. And this idea was also, I mean, we don't have time to go in deep on this issue, but that's also. And in terms of competition cooperation, one topic that we will address, and the beauty probably of this group, of this consortium, is that we work on issues that are related, and there is the issue of the complementary currencies that all aim frequently at building systems like that. They have their strengths and weaknesses and so on, and that could be integrated into that conversation also, I think.
And just to relate also to system thinking and the need to cooperate from different sources, I think this is also part of the discussion here. So to have access to different sources and to different opinions that would be valued the same. Anyway, this is part of this discussion as well.
So we want to be mindful of time because there are other forums to go to, but I think we want to say how very grateful we are to la Fondation des Générations Futures, who gave us the opportunity to have this platform and forum to present our idea of a future baby masterclass, and we know how appropriate the name is now. Marianne, I don't know if you want to say a word for la Fondation closing up the session. As I said, our words would be thank you to you for organizing this for us. Is there anything you wanted to add?
I just would like to add thank you to the three of you for the interesting presentations, and thank you to all the participants for following this very interesting workshop. And I hope there will be many inscriptions, subscriptions for the masterclass. Thank you.
Okay, thank you.
Thank you for organizing it, indeed.
Okay. Enjoy the next sessions.
Yes. Have a nice day. Bye-bye.